Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the trades that actually matter. Today, we are talking about a stock that has been making serious moves, and if you have been watching the rally build and wondering whether the new price targets signal even more upside ahead, you are in exactly the right place. We are talking about NIO, and by the end of this video, you will understand why some of the smartest money on Wall Street is quietly repositioning right now. Buckle up, because this one is going to surprise you. Here is something most investors still cannot believe. A company that was once described as a bottomless pit for capital, a company that burned through billions and kept asking shareholders to stay patient, has just pulled off one of the most stunning reversals in the entire electric vehicle industry. For nearly a decade, the biggest question surrounding NIO was not whether it could grow, it was whether it could survive. Well, as of today, March 25th, 2026, that question has been answered permanently. We are now witnessing a true inflection point, the official graduation from cash burner to profit maker. And buried inside this transformation is one specific deal with a European supercar legend that almost nobody is talking about. We will get there. But first, let us understand exactly what changed and why it changes everything. There are three pillars holding up this new version of NIO, and each one is more compelling than the last. First, the seemingly impossible has actually happened. NIO has posted its first ever GAAP operating profit, closing out 2025 with a result that would have been unthinkable just a couple of years ago. Second, they have done something extraordinarily clever with their battery swapping infrastructure. Most people still think of NIO as just a car company, but they have actually converted 100 million battery swaps into a brand new financial asset class through a $72.7 million battery-backed REIT. And third, they have earned the kind of luxury validation that no press release can manufacture. Their proprietary technology was hand-selected by McLaren, yes, that McLaren, to power their next generation of performance vehicles. The core question for 2026 is simple. Can NIO sustain this profitability while scaling past the 1 million vehicle milestone? And there is one hidden metric inside these numbers that changes the entire story. Let us get into it. If you have not looked at NIO since 2023, you are genuinely looking at a completely different company. The old NIO was a high-burn, single-brand startup selling premium cars exclusively to Chinese domestic consumers. The 2026 NIO is a diversified technology conglomerate. The company has expanded from one brand to a multi-brand ecosystem that now includes Onvo and Firefly. It has grown from purely domestic sales to a global footprint spanning 18 countries. And perhaps, most importantly, the business model has transformed from pure, direct-to-consumer car sales into a hybrid model that now includes business-to-business technology licensing and the monetization of energy through battery as a service. This is not a pivot. This is a complete paradigm shift. NIO is building a moat that looks far less like a car manufacturer and far more like an energy and computing infrastructure company. But none of this theoretical transformation means anything if the actual numbers do not support it. So let us look at the quarter that shook the market. The Q4 2025 earnings report landed like a bombshell. NIO posted a GAAP operating profit between $17.5 million and $40.4 million. In the world of big tech, that number might seem modest, but for a company that was hemorrhaging billions just a few years ago, it is a monumental, historic victory. This profit was generated on the back of 34.6 billion yuan in revenue, which translates to approximately 4.95 billion US dollars. And the deliveries? 124,807 units in a single quarter, a staggering 71.7% jump year over year. NIO has officially crossed the threshold from a story-driven stock into a fundamentally profitable enterprise. But here is the real question. Was this profit driven by sheer volume, or did NIO actually get structurally better at the business of building and selling cars? The answer is pricing power, and it is the metric that separates the survivors from the casualties in today's brutal electric vehicle price wars. While Tesla and BYD are slashing prices and watching their margins evaporate, NIO did something almost unheard of in this environment. They expanded their vehicle margins by 500 basis points in a single year, moving from 13.1% all the way up to 18.1%. Think about what that actually means. In a market where every competitor is racing each other to the bottom, NIO is charging a premium and keeping significantly more of every dollar they earn. This was not luck. It was driven by rigorous structural cost control and deep efficiencies built into their supply chain. For investors who have been waiting for a safety signal, this is it. This is the proof that NIO is not just selling more cars. They are selling better cars more efficiently, with stronger economics underneath. And that efficiency has propelled them to a milestone that only a handful of electric vehicle makers on the entire planet have ever reached. NIO has now surpassed 1 million cumulative vehicle deliveries. In automotive manufacturing, 1 million units is the magic threshold that separates the newcomers from the dominant incumbents. That Q4 ramp-up is not just a spike on a chart, it is a vertical takeoff. By hitting this scale, NIO has achieved the operating leverage needed to make their battery swapping network and software services genuinely profitable. But here is where the curiosity gap opens up. Because while 1 million deliveries is a celebration of everything that came before, the market is already terrified of what comes next. Is this the peak before a painful valley? Could a company this far along actually stall out right at its moment of breakthrough? To answer that, we have to look at where management is guiding the ship for the rest of 2026. In Q1, we are navigating the predictable seasonal dip with delivery guidance set between 80,000 and 83,000 units. A casual observer might panic at that number compared to Q4, but any seasoned investor knows that Chinese New Year and seasonal patterns always compress Q1 figures. The real prize, the goal that every analyst is circling on their calendar, is targeted full-year break-even by late 2026. If NIO can maintain this trajectory and close the year in the black, the entire bear case for this stock does not weaken. It dies permanently, and the strategy to get there is built on attacking the market from multiple directions simultaneously. This is where the multi-brand ecosystem comes into sharp focus. At the center, you have Core NIO, the premium flagship that built the brand's reputation. Expanding outward, you have Onvo, specifically the L60 model, targeting the mass market buyer who wants NIO technology without the premium price tag. Then you have Firefly, the entry-level brand designed for first-time EV buyers. Spread across 18 countries, this architecture allows NIO to amortize its enormous technology costs across millions of units rather than hundreds of thousands. It is the same playbook that made Volkswagen and Toyota into industrial giants, but rebuilt from the ground up for the electric age. And now, NIO has found a way to sell that technology directly to their competitors. This is the payoff for years of research and development spending that once looked like reckless burning. CEO William Li confirmed a supply agreement to provide NIO's proprietary 4680 cell battery packs directly to McLaren. When one of the most prestigious supercar brands on the planet selects your battery engineering over every alternative available, the quality debate is officially over. But it does not stop with batteries. NIO's Shenji computing division is actively licensing its proprietary processing technology to other automakers, creating high-margin business-to-business revenue that acts as a genuine hedge against the cyclical nature of car sales. They are monetizing their intellectual property. And their biggest physical moat is not in a laboratory. It is sitting on street corners in cities around the world. As of February 2026, NIO has completed 100 million battery swaps across more than 3,700 active stations, with plans to add another 1,000 stations this year alone. NIO Power is no longer just a charging alternative. It is the most robust proprietary energy network in the entire EV sector. It eliminates range anxiety. It eliminates long charging stops. In a NIO, you do not wait 40 minutes. you swap in 3. But here is the challenge. Stations are expensive to build. So how does NIO plan to expand this grid aggressively without destroying the profitability they just worked so hard to achieve? The answer is a masterclass in financial engineering that most retail investors completely missed. NIO has created an entity called McLaren to operate their battery assets. By issuing $145 million in green asset-backed notes and launching the world's first $72.7 million battery-backed REIT, they are using institutional capital to fund the expansion. This battery-as-a-service model transforms physical batteries into a predictable, yield-generating financial instrument. It allows NIO to remain asset-light while simultaneously owning the most critical charging infrastructure in the game. So with all of these extraordinary milestones stacking up, why is the stock still sitting where it is? Despite everything we have just covered, shares are currently trading in the $5.75 to $5.82 range, still hovering near multi-year lows. On March 23rd, we saw a 7% single-day rally driven by optimism around that battery financing structure. Year-to-date, the stock is up roughly 14 to 16%, which is actually outperforming many of its peers. But here is the incredible disconnect. A company with 1 million deliveries, 18.1% margins, a GAAP operating profit, and a McLaren partnership is still being priced as if it were a struggling startup. The gap between fundamental reality and market valuation is widening, and the largest financial institutions in the world are starting to take notice. HSBC, Nomura, and Freedom Capital Markets have all recently upgraded NIO to a buy rating. While the stock sits around $5.75, institutional price targets are clustering in the range of $6.80 to $7.28. That is a meaningful gap of potential upside sitting right in front of us. Wall Street is shifting toward cautious optimism based on these structural improvements. They see the margin expansion. They see the technology licensing revenue. They see the clear path toward full-year break-even. But to be responsible here, we absolutely have to look at what could go wrong. The two most significant external threats facing NIO right now are global memory chip supply constraints and the relentlessly intense competition from BYD and Li Auto. CEO William Li has been transparent. If chip supply tightens, production slows. And the price wars in the Chinese EV market are brutal with no signs of easing. However, NIO's non-production revenue from Shenji technology licensing means they are no longer purely dependent on how many cars roll off the line in any given month. And their 18.1% margins, combined with the multi-brand rollout, give them structural insulation that simply did not exist 2 years ago. They have never been better protected. Which brings us to the big question: what is all of this actually worth if the market finally catches up to reality? Here is the asymmetric upside case laid out plainly. A company with 1 million deliveries, 18% vehicle margins, a first-ever GAAP profit, institutional upgrades from top banks, and a McLaren partnership, trading near multi-year lows. If NIO hits its full-year 2026 break-even targets and the market re-rates this stock toward fair value, analysts are pointing toward a potential recovery toward $18, representing a recovery of 300 to 400% from current levels. The underdog has turned the corner. NIO is no longer speculative. It is a mature, diversified technology and automotive conglomerate that is currently on sale. Before we close out, a friendly reminder, like always, and this is important, nothing in this video constitutes financial advice. Smart Stock. SAM is an educational and informational channel only. All information presented here is based on publicly available data and should not be taken as a recommendation to buy, sell, or hold any security. Investing in individual stocks involves significant risk, including the potential loss of your entire investment. Always do your own research and consider consulting a licensed financial professional before making any investment decisions. Past performance and price targets are not guarantees of future results. Now, the reality has decoupled from the valuation. The question is simply whether you are going to wait for the rest of the world to see what the data is already telling us, or whether you are looking at it right now. If this video gave you a new perspective on NIO, drop a like, hit subscribe, and let me know in the comments what stock you want us to break down next. This is Smart Stock Sam. Stay disciplined, stay curious, and I will see you in the next one.